Management accounting is about using information and then overcoming short-term constraints on the business to maximize the throughput and maximize our contribution. And that's what we'll focus on when we're in class together. Management accounting is inextricably linked to the whole organization. You will be a key cog in the business, right? A vital cog in the business. And it's all about information, analyzing information, getting data. How does it apply to the rest of the organization? And all that data will generally feed through your finance systems. And then you want to start thinking about risk. You'll start working with your risk management teams. This then all leads into strategy and your strategic objectives for the organization. And now you've got to think about the little steps on how you're going to get there. Right? So all this information feeds into senior management, and you will be making recommendations. You will have to analyze the problems and the pitfalls and where an organization or a strategy needs to evolve, and hence implement craft in, craft out strategies. What are the roles and responsibilities of the management accountant? Well, ultimately, at first, you'll start off thinking about costing. What is the cost of a good or a service? And how do we come up with a cost per item or per batch? It's not necessarily looking at your total costs as you would in financial accounts. Another thing you've got to be very careful about, and what you'll be involved with, is decision making. And these decision making can be, what can we make? What should we make? Another thing, very important, how do you finance the business? How do you finance a division? Or if you're going to launch a new product or make a new investment and pursue a new project, where are you going to get that money from? Because we need money to make money. So how are you going to finance it? You can't just get it from center. And you've got to make a plan and a business case for that. Very importantly, you need to assess whether a project is worthwhile. Cost classification. We can group different costs. We're not going to just look at operating costs or cost of goods sold. All right. What we can do now is look at all our different costs in our organization, or in a project even, and we can then group them by function. Are they administrative costs, our production costs? So these are our key costs on actually making the product, or the expenses of marketing and raising awareness of these products, finance costs, and so forth. So we could either do it by function or by the nature of the costs. So we can group all the raw material costs together, all our wages from around the world, or even within a small project, within a small little business or a small factory, or all our indirect costs, which are called our overheads. So we can look at costs in many, many, many different ways, and we can have a lot of different terms to identify and manage costs. But ultimately, costing, what we're trying to do is identify the total cost of making a product. Okay, and this is essential because if you are spending more to make a product than you can earn to sell the product, or in selling the product, you're going to go bust in the long term. So just because you're making a loss doesn't necessarily mean it's a bad thing initially, but what you have to do is either take costs out or raise the price, or both, to make sure it's viable. Because ultimately, as you know from your financial accounts, the profit is just an accrued or an accrual concept. It's not actually cash. And cash is essential in business. Another way we can interpret these costs and look at different costs are our production and our non-production costs. And our production costs are made up of materials, labor, and direct overheads. So these are anything that are directly attributable to the manufacturing of the product itself. These are called our prime costs, right? These are absolutely key in the manufacture of the product itself. Our non-production costs, wow, these are all the ancillary costs that we need to incur. Light, water, cooling, refrigeration, storage, people, staff, your chief exec salary. Absolutely. These are non-production costs, okay? Generally known as an overhead because they don't directly make the product. So they're an indirect cost in the organization. And under those four headings of your non-production costs or overheads, we have lots of different examples that we can also talk about. Now, ladies and gents, one thing that's absolutely key in management accounts is an internal reporting analysis mechanism and approach and philosophy. And what you're doing here is all about how you interpret things, how you want to structure the analysis of this information. So what we could do, for example, you've got here your finance department salaries, Well, they may go in under salaries, which might be perceived internally as an administrative cost and not a finance cost. Software might have its own cost center or overhead allocation cost. Now, your prime costs, as we've talked about, the key drivers of, or the key costs incorporated in making your product, these will vary directly in proportion with the number of products you produce. So as output goes up, these will go up. In your fixed costs, we are going to assume that they remain constant over a period of time. They set in stone. Very difficult to change your fixed costs in the short term. You can do anything in the long term. Short term, you can't do too much. But we consider our fixed costs sunk for short-term decision-making. Now, we all know that profit is our total sales minus our total costs, and our total costs are made up of variable costs and fixed costs, right? Or our prime costs and our overheads. Now, if we're assuming our fixed costs are sunk, let's ignore them. We don't take them into consideration. So now we're going to introduce this concept of contribution. And that's a vital, vital concept in management accounting. And we use this contribution to make decisions. And we use that to undertake an analysis of how we can overcome short-term disruptions in an organization, facing us to maximize our profitability and value creation, and how we can try and meet our strategic objectives. Now, within investment making, because this is going to be an investment in what we need to do, right? It does form part of your capital budget. So what are we going to be doing for the long term? Spending money now, investing for the long term. And we do this through being considerably aware of what's going on in the operations and in the organizational environment in which we're operating. Or we see, whoops, we've got an internal issue that we need to address. So what we can say is that we've got more and more and more demand. We can't get the skill sets because our product is very labor intensive. So what we're going to do is change the way we make the product from being labor intensive into a more automated process. So we need to invest in production lines. And the mechanisms and the approaches we can take to try and analyze this and these evaluation techniques are numerous. But what we'll look at now for management accounting, using management accounting concepts, is the net present value concept. But because of that, we've got to introduce this idea of time value of money. And all that means is that a pound today is not going to be able to buy you as much as it can buy you today in the future. And our formula for our net present value is just the sum of all our future net cash flows over the life of the project, discounted by a certain discount rate. In certain projects, you'll have a continuum or a constant cash flow. And in that case, what we could do is use an annuity factor. And that's just the sum of all the discount factors or discount rates over that time period at a certain discount rate. Right, so we could use the formula of that cash flow, that constant cash flow, multiplied by an annuity factor, which is given to us by that formula. What we do know is that an investment is acceptable if it is net present value positive. So what we're going to do is accept it if our present value of all our future cash inflows exceed the present value of all our future cash outflows. The net present value focus is just going to be on all the investment going out up front. And then we've got our volume times the sales price minus our variable cost, not our total cost, just the variable cost, our relevant costs of labor and materials, our prime costs. And we're going to multiply that by the annuity factor. So a simple example here for you, a company has the opportunity to invest in plant and equipment to manufacture a new product for which demand is estimated to be 5,000 units per year for 5 years. You've got a whole lot of more extra information detailing the costs and the associated implications of this project, and you're told that the project has a 10% discount rate, or the cost of financing, cost of equity, weighted average cost of capital. What we're assuming here is that we don't need any extra working capital. We've been told ignore tax because the tax people sort that out. So the question now to pose is the project viable? So let's analyze it. On the face of it, we can apply our formula, and we're just going to get our annual cash flows, and annually our cash flow is going to be £15,000 positive. Applying our annuity factor of 10% for 5 years, we can work it out to be 3.791, or we can get it from our discount tables. We multiply it by our annual cash flow, offset against our upfront investment today. Now that's discount rate of 1, and we get a net present value of 6865. That's great, wonderful, accept the project, happy days. It's net present value positive. We've got a great return on investment of 13.73%, far exceeds the cost of capital, but we have not analyzed the variables that go into making up this decision. Do you trust the information you've been given or you've been able to source? In order to do this, we need to undertake a sensitivity analysis. And what we're going to do is try and tweak the variables to assess the impacts of any changes to these variables. All right, and what we're going to try and identify is look at the dependent variable, net present value, and we're going to change all those independent variables to see how it's going to impact on our net present value to try and assess our margin of safety. So here, net present value is 0, as you can see on the end, and we're going to see what our investment is. Now, naturally, yes, this is quite simple because all it is the net present value positive element of 6865, and we're going to add it to our investment. So that's quite straightforward. Now, by how much can the volumes drop each year in order for that project to still be viable? Putting our net present value at 0. And we can see here that 5,000 unit expectation can only drop to 4,396 per year in order for this project to be viable, keeping everything else static. And that's a problem. That's a big risk. Now, if we put our sales to, and we're trying to work out our selling price, well, that can only drop from £10 to £9.64. Now, there's a concern, right? So it can only drop 36p. Labor, well, labor can go from £4 to £4.36, and we'll still be positive, net present value positive in that realm. Our materials or raw materials can change from £3 to £3.36. Our cost of capital can move from what we're using currently of 10% up to 15%. And that is okay, but that might not be acceptable internally, because maybe internally you've got a hurdle rate of 20%, or you need 15, and this might be very close to that 15 as a hurdle rate. So hence we can then work it out through interpolation to get it at 15.24% as our discount rate. The life of the project, well, our projects assume that it's going to last for 5 years. We want to know when we effectively break even using discounting. Again, we look at the 3.333, but now we're going to look at the 10%. Again, using interpolation, we can then work out it's basically going to break even in 4 years and 3 months. Now, to me, that's a huge concern, that your project only becomes viable 82.5% into the life of the project. Again, is that acceptable or isn't it? Now, you've got to analyze and determine that. We can then summarize all of our sensitivities, and what we're going to be looking for here is the delta. We're looking for the change from the original estimate of any of those variables before our project becomes loss-making. And the biggest concern here should be your selling price. And as we know, the more we sell, the more people want discounts. Over time, as people become tired of your product, you have to amend your price. Okay, so there's your your biggest sensitivity, probably one of your biggest risks, but there are a number of elements there. We need to be aware of what's happening, not just each individual fluctuation variable, but what's happening if all the variables start changing together, right? And we've got this hotbed of uncertainty going on. And what we need to do then is start simulating a potential outcome to use that in making our decisions. When you're thinking about project and project analysis and risk management, you've got to accept the fact that it's inherent in business, but you've got to embrace it. Well, you can only embrace it if you can manage these risks effectively. So you have to have a margin of safety. You've got to have some flexibility. You've got to undertake your sensitivity analysis. You've got to reflect, what do we do well? So this is called your post-completion audit. And I just love this cartoon. And to me, yeah, we all perceive risks differently. We all perceive the execution of projects differently. We can analyze until the cows come home, but we've got to act. And just putting your fingers in your ears and doing nothing, it's doing something, but it's probably not the right thing to be doing.